Welcome to CM Trading Academy. In this series of lectures, we're going to be going through the simple ideas of what is Forex really, how does it work, we need to look at things like market size and liquidity, and when are the good times to trade. The idea with the first series is that we're going to be looking at more of the theory and the understanding of what Forex is and how does it actually work, so we can dispel a lot of the myths behind it. In order for you to become a complete trader, where you understand all of what you're doing, we need to make sure that you have the theory done. So that's what we're doing with this first series. Don't worry, later on we'll load up the platform and we'll start playing around with various indicators, putting it all together, getting a strategy, looking at risk management and all that sort of thing. But before we get to the actual trading, we just need to make sure that you understand more about what it's all about. What is traded and how? In essence, we are trading foreign currency. Depending on the strategy you are using as your main strategy, you will determine whether or not a currency pair will trade up or down, and then you trade accordingly. There is no physical exchange of money. You open up an account with CM Trading, make a deposit to their account. They handle all of the nitty-gritty. Besides your deposit and your withdrawals, there's no actual exchange of money. All of this is handled by a broker, and is why there's a good reason to stick with a reliable and regulated broker like CM Trading, because they are going to be managing your money. All trades are made in pairs. Think of trading as a boxing fight. Two currencies make up a pair. For example, the euro-dollar. If you feel the euro is going to get stronger than the dollar, then you want to buy euros. If you think that the US dollar will strengthen, then you want to buy US dollars. Each trade is a simultaneous purchase of one currency and the sale of another, meaning when you are buying one currency, you're automatically selling the other. For example, in the euro-dollar example that I just had, if I said that we are going to be buying euros, you will also be selling dollars at the same time. And if you are buying dollars, then you will be selling euros at the same time. This will apply to any currency pair you're looking at. If you are trading, say, the British pound versus the US dollar, then if you want to buy pounds and you're looking at the pound-dollar pair, you would then be selling US dollars. And if you are buying US dollars, you would then be selling Great British pounds. Now, we have access to a lot of different currencies from all sorts of different countries, but the main five, or what people like to call the big five, are probably the most important ones to look at. These are the guys that really dominate the market. Now, I've listed the big eight in front of you, because some of the guys like to refer to the big eight, but really the first five are the biggest and the most important ones. Right up at the top spot is the United States dollar. You'll see a little bit later just how much the US dollar actually dominates the market. I've gone ahead and I've listed them out. We've got the US dollar, the Eurozone, the Japanese yen, the Great British pound, and the Swiss franc. Those are the top five that we're going to be looking at most of the time. And there are a few nicknames which you will need to get used to. The two important nicknames that get referred to quite a lot is the fiber and the cable. The cable got the nickname thanks to the transatlantic telegraph cable. It connected the New York Stock Exchange to London Stock Exchange, and so they affectionately called it the cable. It was the first time that two very far apart stock exchanges on different continents could actually be connected in nearly real time. The fiber is the new version of the cable, fiber optic, which is connecting the euro and the US dollar. So generally, when people refer to the cable, they're not referring to just the British pound, but they're referring to the British pound versus US dollar currency pair. Outside of the big five, I personally really enjoy trading the Australian dollar versus the United States dollar. It's a fun pair to trade. So if you find that other things are a little bit quiet, go ahead and have a look at that one. Let's have a look at some of the more common currency pairs that are traded. You'll find that the number one pair traded is the euro-dollar. This makes up a huge portion of trades worldwide, not just with retail forex traders like us, but also companies doing a lot of imports and exports. Why it is important for us to look at the pairs that are traded a lot by other people? There are a couple things that you need to keep in mind. First of all, when we're trading forex, we can make money when the markets are going up or when they're going down. We can't make money when the markets are moving sideways. So we need to look at pairs where we have a decent amount of movement. If you choose a pair where there's very little trading going on and it's just kind of moving sideways, there's not going to be a lot of movement, which means there's not a lot of opportunity to actually make profit from. The next thing to look at is that when the cost of trading comes into account, we need to look at pairs that are a little bit cheaper. We find that the more popular a currency pair is, or the more popular a specific currency in that pair is, then the cheaper it is for us to trade. If you look at the old business principle that applies today as it did 100 years ago about supply and demand, we find that if a lot of people are trading, say, the euro dollar, now that means a lot of people are buying and selling both euros and dollars. There is a lot of supply of it, and it starts becoming a lot cheaper. Also, because everybody is buying and selling, they're generally more willing to negotiate a little bit on the price that they're going to sell it at. So there's a lot more competition between all of the banks and the importers and exporters and that sort of thing. So that we find the spreads are generally a lot tighter on pairs like the euro dollar. The more uncommon pairs you'll find can actually be very, very expensive. Now, if you're scalping, it's very important to look at trading cheaper pairs like the euro dollar, the dollar yen, the pound dollar, dollar Swissy, that sort of thing, because you're going to be trading, say, 2-3 times every single day. So if you're being charged a little bit more per trade, it starts adding up very quickly. If you're trading longer term strategies where you're only, say, trading once a week, well, then you can start trading the uncommon pairs and it won't really affect you very much. But for the very aggressive scalping systems, it's a good idea to try and focus on the major currency pairs that are being traded, the ones that you can see in front of you now. One more thing I need to point out is some of the lingo can be a little bit confusing. For example, if you look at the Australian dollar versus the US dollar, we refer to that pair as the Aussie dollar. Now, it sounds like we're referring to just the Australian dollar, but we're not, because the Australian dollar's nickname is Aussie, and because the United States dollar is the biggest one, they're just the dollar. So Aussie dollar is Australia versus the United States.